In this video, you're going to learn about a financial instrument that traders use to make huge returns relative to the stock price. Stick around to learn everything you need to know about call options as a complete beginner. So let's start with, what is a call option? A call option is a financial tool that gives the buyer the option or right to buy something at a fixed price within a specific time period. With stock options, a call gives the buyer the right to purchase 100 shares of stock at a fixed price between now and the option's expiration date. But let's learn with a real example. If I say I am going to buy the Apple 150 call option expiring on June 16th, 2023, here's what it means. Apple is the stock or the asset that this call option is able to purchase. 150 is the strike price or the fixed price the call owner can purchase 100 shares at. And June 16th, 2023 is the expiration date, which is the last date the option can be traded or used to buy shares at the strike price of $150. So this option gives the buyer, or me, the right to purchase 100 shares of Apple at $150 per share at any time on or before June 16th, 2023. With this basic definition in mind, how do call option traders make money? The simplest understanding is that call options increase with the stock price, so traders will buy call options when they believe a stock will increase a lot in the near future, or at least before that call option's expiration date. In this graph of a stock price and a call option with a strike price of 190, the stock and call prices move in tandem, demonstrating that call prices go up and down with the stock price. If call options go up and down with the stock price, then a natural question you might have is, why do traders buy and sell call options instead of just buying and selling shares of stock? The answer is that when trading call options, you have a bigger return potential compared to the stock's price movements itself. In this past graphic, we saw that the stock price went from around $188 to $208, or an increase of about 11%. However, the call price went from $5 to $18, an increase of about 260%. So to look at a real example of recent stock price and call option history, we can look at Apple's stock price in the end of 2022. During this highlighted period, the Apple shares went from around $135 up to $158, or an increase of 17%. The Apple 130 call option expiring in January of 2023 went from $14 to $30, or an increase of 114% over the same exact time period. So Apple shares went up 17%, but this January 130 call on Apple went up 114%. A $10,000 investment in the shares would have returned $1,700, while a $10,000 position in those 130 calls would have gained $11,400, which is of course way more than simply investing in the shares. If we instead allocated $800 to the call purchase, that 114% increase would have resulted in the same $1,700 profit that the stock position realized. The next question is, why do call option prices move up and down as the stock price goes up and down? The simplest way to understand this is that a call's value stems from its ability to purchase shares of stock at the fixed strike price, which gets more or less valuable as the stock price goes up and down. To visually understand this, if the call's strike price is $150 and the stock price is $160, the call can buy shares $10 below the current share price, which gives the call a value of $10 per share. If the stock price increases to $175, the 150 call can now buy shares $25 below the share price, giving the call a value of $25 per share. So traders make money by purchasing call options, hopefully seeing the stock price increase way above that call's strike price, and then the call trader can simply sell their call position for a higher price. So take a look at this historical call option trade. The stock price was $94, and we're looking at the 92.5 call that had 42 days to expiration at the time of entry. The initial purchase price of the option was $4.65. As the stock price went up, so did the value of the call. At expiration, the call was worth approximately $13.50, which is 190% more than the purchase price of $4.65. This example brings us to two important call option concepts that you need to learn. These are intrinsic value and the break-even price. Intrinsic value is equal to the benefit of buying shares at the call's strike price instead of the current stock price. If a call's strike price is $90 and the stock price is $105, the call's intrinsic value is $15. That is, there's a $15 benefit of buying shares at the $90 strike price instead of the $105 share price. So if the stock price is above the call's strike price, the call's price will be at least the value of its intrinsic value. And at expiration, a call's value will be equal to its intrinsic value, if any. If the stock price is below the call's strike price, the call has no intrinsic value. In the previous example, when the stock price was $102.50, the call's price was over $10 because the 92.5 call could buy shares $10 below the $102.50 stock price. At expiration, the stock price was around $106, and the 92.5 call could therefore buy shares $13.50 below the stock price. The call's price ended exactly at that price of $13.50, or its intrinsic value. The break-even price is the stock price that leaves the call option with intrinsic value equal to the option's purchase price at expiration. The break-even price is equal to the strike price plus the amount paid for the option. In the previous example, the break-even price was $97.15 because the 92.5 call was purchased for $4.65. So if we take 92.5, which is the strike price, and we add the purchase price of $4.65, we get an expiration break-even price for this trade of $97.15. This means that if the stock price is $97.15 at expiration, the call will be worth $4.65, which is the same as the purchase price, and therefore the trader won't make or lose any money. So in order to make money on a call option purchase at the time of expiration, the stock price needs to be higher than the break-even price. But the stock price doesn't need to be above the call's strike for the call to have value. If a call option has no intrinsic value and has a price above zero, the price is purely extrinsic value. Extrinsic value is any value an option has above its intrinsic value. Extrinsic value is sometimes called time value. Even if an option has no current intrinsic value, if there's lots of time left until expiration, there's potential for the stock price to increase and leave the call intrinsically valuable. This is important because as a call option trader, you can make money by purchasing calls and selling them for a higher price, even if the stock price never gets above the call's strike price. To prove this to you, let's look at a specific example using historical option data on Apple. Here we're looking at the Apple stock price versus the Apple 180 call option expiring in December 2022. The starting point is in June 2022. In the first 60 days of the trade, Apple's stock price went from around $130 to $175, which is obviously a massive surge in a short amount of time. The 180 call went from a price of around $1 to over $9, or a 9 times increase in its price. Note how the stock price never got above the strike price of 180, but the option went up 9 times. The option's price was purely extrinsic value over this entire trade because the stock price never got above that 180 strike price, meaning the call option never had any intrinsic value. So if I had a crystal ball, I could have purchased this call option at the beginning of the period for $1 and sold it at the top for $9, making 9 times my money, even though the stock price never got above the strike price of $180. So the question is, why did this call option's price increase? First, the stock price was $50 below the strike price of $180 at the beginning of the period. But with 182 days to expiration, there was lots of time for Apple to potentially get above $180 and provide the call with intrinsic value. The probability of a 40% stock price increase in 6 months is low, but not zero, which is why the call's price itself was low, but also not zero. Against the odds, Apple's stock price surged to about $175 in the first 60 days of this trade. With the stock price now only $5 below the call's strike price of $180, and with 120 days until the call's expiration, the call's price was now $9, reflecting the increased probability of Apple getting above $180 and providing the call with intrinsic value before its expiration date. Unfortunately, the fun didn't last long, and as the stock price plummeted far below $180 and the call's expiration approached, it became increasingly likely that the call would expire worthless, and its price reflected that change and headed towards zero. The lesson here is that call option prices are a function of probabilities. What is the probability that the call will be valuable at expiration? If a call has a high probability of being worthless at expiration, its price will be close to zero. If a call has a high probability of being super valuable at expiration, its price will be high and will always be at least the intrinsic value it has at any given moment. I recently created an options course with detailed analysis and statistics of a simple but historically effective call buying strategy. The course includes exclusive video lectures on my analysis of options trading strategies designed to reduce the guesswork and emotion from our trading and ultimately increase the odds of making money long-term with options. If that sounds interesting to you, check the link to the course info page below. Thus far, we've only talked about how the stock price will influence the changes in the call options price, but there are additional factors that determine whether a call option or any option will gain or lose value over time. The other two huge factors are expected volatility and time until expiration. So let's talk about those right now. So if we look at this next graphic, we are looking at a less volatile stock price and a cone that shows the theoretical expectations for that stock's price going into the future. So a low volatility stock, such as Coca-Cola, will have cheap options because of the small expected potential stock price increases. But volatility expectations are not constant, and so we can imagine a scenario where volatility is changing as we are trading options, which happens in real time every single day as stock prices change and new information comes into the market. So if we look at this graphic here, we have two cones. One is demonstrating a higher volatility stock price expectation, and inside that we have a smaller cone that represents lower volatility expectations. So if we imagine we buy options when we have high volatility expectations, and then those volatility expectations fall, the result will be a drop in option prices, and we will lose money from buying and holding those options through the contraction of the volatility expectations. In this graph, I use an options pricing calculator for a 200 strike call with 90 days to expiration. The higher curve is a starting implied volatility of 30%, and the lower curve is an implied volatility of 20%. Implied volatility is a measurement of a stock's expected price volatility as expressed through option prices, and implied volatility is largely driven by a stock's volatility. Basically, what this graphic is showing is that if I bought this call option and implied volatility fell from 30% to 20%, I would lose about $375 from this particular trade. If you buy options and implied volatility falls, that means the option prices have fallen because the market expects smaller stock price movements going forward, and you will lose money from the decrease in option prices from this decrease in the stock's volatility expectations. But the opposite can also happen. Imagine buying a call when expected volatility is low and then rises. This means that the market expects bigger stock price movements and therefore more potential for the calls to become intrinsically valuable before or at the time of expiration. The option prices will increase and a call owner will make money even if the stock price doesn't move. Based on another simulation like before, if implied volatility went from 30% to 40%, the trade would make about $375 from the increase in volatility expectations. So if implied volatility went up, that means the option prices got more expensive due to an increase in the market's expectation of stock price movements going forward. Now let's talk about perhaps the most important factor other than the stock price that will determine whether an option trade makes or loses money, and that is time. To understand this, let's imagine the potential stock price movements over different periods of time. In these images, we are looking at Apple options with different amounts of time, but we're looking at call options with the same exact strike price. So we're looking at 140 strike call options in Apple, but the only difference is that they have different amounts of time until expiration. We can see that the 45-day call option with a strike price of 140 is trading for $8.70, but the 409-day call option with a strike price of 140 is trading for $25.15. So bigger Apple price changes are possible over 409 days as compared to 45 days, and that's why the longer-term option with the same strike price is trading for a much higher valuation. So based on these two prices, we would expect to lose around $1,645 from holding the 409-day call option from 409 days to expiration all the way to 45 days until expiration. So if the stock price and volatility expectations remain constant, we would lose money from buying and holding this option, because the passage of time reduces the likelihood of big stock price movements and therefore reduces the price of this call option. Let's look at a cleaner example using simulated call price curves for a 200 strike call with 25% implied volatility and various amounts of time left until expiration. From top to bottom, we have 90 days to expiration, 30 days to expiration, and expiration itself. The call starts at around $10 when it has 90 days to expiration and the stock price is $200. The call's price falls to about $6 when it has 30 days to expiration and the stock is $200. So if I bought the call at 90 days to expiration and held it for 60 days without a stock price increase, we can see that I would lose money from that passage of time. And remember, a call will only be worth its intrinsic value at expiration, which is only positive if the stock price is above the strike price. And we can see that if we look at that expiration line, the line is only above zero if the stock price is above $200. So if I bought this call with 90 days to expiration and the stock price remained at $200 until expiration, the call's price would go to zero and I would lose 100% of the money I put into the option. So putting all of these pieces together, the primary call option influences are changes in the stock price, volatility expectations, and the passage of time. Increases in the stock price and increases in volatility expectations both work to increase the value of call options. What this means is that when you buy a call option, you need the stock price to increase and or volatility expectations to increase to offset the negative effects of the passage of time on your call option purchase. This is exactly why you can buy a call, see the stock price increase, but you can still lose money. You can lose money because the stock price increase didn't happen fast enough and the passage of time decayed that option more than the increase in the stock price appreciated the option. And also, the stock price could have increased and volatility expectations could have come down, and that wasn't enough for the option to increase in value. So the stock price is not the only factor when determining if your call option purchases will make or lose money. So to purchase a call option in Amazon, first I'm going to go to the trade page by clicking on this trade tab right here. And then I'm going to personally go to the June 2023 expiration cycle because it has 180 days until expiration. Personally, when I purchase options these days, I like to go a little bit further out in time because these options do not decay as quickly as more near-term options. And also I have more time for my outlook to play out. So I'm not saying that Amazon's going to be going up in the next 4 days or the next 30 days. So I'm not going to purchase a call option in these shorter term expiration cycles. My outlook is that Amazon will have a substantial increase somewhere between the next 30 to 90 days. And so for that, I'm going to choose the 186-day expiration cycle. I could go longer, but for this demonstration, I'm going to choose the 186-day cycle, which is the June 16th, 2023 expiration. And for this, I'm going to purchase the at-the-money call option. This means I'm purchasing a call option with a strike price that is very close to the current share price. So since Amazon shares are currently trading for $89.60, I am going to be purchasing the 90 call option. We can see that the bid price is $12 and the ask price is $12.20. And this means that this option is trading for roughly $1,200.
Chris forgot to mention something important. Stock option prices are worth 100 times the displayed price on the trade page because an option can buy or sell 100 shares of stock at the strike price. The $12 price here means a trader needs to pay a premium of $12 per share for the ability to buy 100 shares at the strike price of $90. A $12 premium per share times 100 shares equals a $1,200 total cost. The 100 times multiplier is called the option contract multiplier and is standard for options on stocks like Apple or Tesla. All right, back to the demonstration.
So the maximum I can lose for purchasing this call option is going to be $1,200 if I buy it for $12.05. And that's much lower than the maximum loss potential of purchasing 100 shares of Amazon at $90. So if I purchase 100 shares for $90, I will pay a total of $9,000. And if the share price goes down 30 points, then I will lose $3,000 as opposed to $1,200. But the upside is also unlimited on this call option. So I can make a lot of money, but I have limited downside. But For that trade-off, I'm going to have a limited window of time for which I can make money, which is that 186-day expiration. So I've clicked on the ask price of the 90 call, which sets up an order to purchase one contract of the 90 strike call option in Amazon. We can see that the price is listed at $12.05, and we can see some statistics here. Namely, we can see the max profit says infinity. That's because there is no limit to how much a call's price can increase, since the call option's value will go up as the stock price goes up. And since there's no limit to how high the stock can go, there's no limit to how high this option value can go. The max loss is $1,205. The buying power effect, or how much money I need to enter this trade, is the maximum loss potential of $1,205. We can also see some other things such as the theta, which is basically how much money this option is expected to lose on a daily basis. So basically, if I buy this call option and Amazon stays completely flat with each passing day, this position is expected to lose about $3 per day, and this will accelerate as we get closer and closer to expiration. But basically, theta is just telling us that since we have a negative theta number, this is a position that is going to lose value as time passes, which is also something that we discussed in this video. So I'm happy with this. I want to go ahead and try to enter this trade. So I'm going to hit review and send with the price at $12.05. I hit review and send, and this brings up a page that tells me everything about this trade. It's telling me I want to do a limit order at $12.05, meaning I want to buy this call option for $12.05 or less and not a penny more. The time in force is day, which means that if I enter this order and the trading day ends, then this order will be canceled. The estimated trade cost is $1,205, which is basically the maximum loss potential of this trade. Then if we add the commissions in and the small fees, we get a total trade cost of $1,206.12. So I need $1,206.12 of available cash to purchase this call option. So I'm going to hit send order and see what happens. If I go back to my positions tab and open Amazon, we can see that I have a working order, meaning that this order is not filled. It is out in the world and it is trying to get filled, and we're trying to see if someone is going to take the other side of this, but it is not currently in my portfolio yet. So this is a working order. We can see the mid price is $12.10 and my limit order is $12.05, and this means that basically I need to increase my order price or my purchase price if I want to get filled on this trade quicker. So I could wait here and see if the price comes down to $12.05. That could take a matter of minutes, or maybe it takes a couple days. If Amazon keeps going up and the call price keeps going up, then I am not going to get filled on this order at $12.05. So since I want to get filled on this order and I'm not concerned about the 5-penny difference, I'm going to right click, hit replace order, and I'm going to go up to $12.10. I'm going to hit review and send order. Go back to my positions tab and we can see that still I'm not filled on this trade. I could wait here for a few minutes, and that's what I'm going to do to see if it goes through. So there we go. I just got filled on the Amazon order. We can see that I had to enter this order and change the price one time, and then I was just waiting for that working order to potentially get filled, and eventually the market came to that price and I was able to buy this 90 strike call option expiring in 186 days for a price of $12.10. Now this means that I actually paid $1,210 to enter this call position, and to the right of this column, we can see the mark, which is the current market price, and it's saying that this call option is now valued at $12.07, and my P&L is a negative $3. So as the stock price changes, and as time passes, and as volatility expectations change, this call price is going to change constantly, and so will my P&L. So right now, I could sell this call option and exit the position, but if I were to sell it for $12.07, I would realize a $3 loss on this position. For this call option, we are going to check back in a few days to see how the stock price has changed and how the call value has changed as well, and what that means for the profitability of this position. All right, so I've entered this call position in Amazon and I've waited 39 days, and this is just the time I'm recording it. I didn't plan to wait 39 days, but it's been 39 days since I initially entered this Amazon call position, and currently this 90 strike call position in Amazon in the June 2023 expiration cycle is currently trading for $14.95. We can see that by looking at this mark column, which essentially just tells us the current market price of this option. The trade price of $12.10 is my entry price. So I purchased this option for $12.10, or a total cash outlay of $1,210. Currently, this option is trading for $1,495, and we can see that I have a $285 profit. So the P&L open is the profit or loss that I have since opening this trade, and we can see that it's currently up $285, 82 of which came today, which is designated by this P&L day column. Also, I know that I've opened this position 39 days ago because we have this days open column, which says 39 days. So I want to go to the chart of Amazon to show you when I entered this position. I entered on December 12th, and at that time, Amazon was somewhere around $90 per share. We can see that we had this huge jump up to around $95, $96 right after I entered the trade, but I did not close at that time. And then, unfortunately, we saw the stock price go way down all the way to about $81 per share, or about $10 less than the entry price, or the stock price at the time of entry of $90. And then fortunately, the stock price recovered, and now I am sitting on a $280 profit on this call position. Really quickly, I want to show you how the call position itself actually performed throughout that stock price decrease. So if I go to the trade tab and I go to the June 2023 expiration cycle, we can see this little white dot here. This means that I have an open position in this expiration cycle. So if I open the June 2023 options, we can see that I have this one long call option at the 90 strike price, and we can see that the option price is trading around $15. To view the option and chart, I just have to right click on one of the prices and click view option in chart. And then this brings up a chart of the specific call option that I've purchased. So I put this vertical line here to show when I entered the trade, and we can see that I purchased it right around $12.10. And then when that initial stock price surge happened, the option price went up to $16. And then, of course, we saw that big slide in Amazon down to $80 per share. And when that happened, this 90 strike call option in June of 2023 fell to a price of around $6.85, or right around $7. So at one point, I was down $500 on this particular call option, but fortunately, since the stock price surged higher and is now at $97 per share, the option is now trading for $15.10, and I am up around $300 on this trade. So to show you what it looks like to actually close this position for a profit, I'm going to close this position and sell this call option. And I want to do this because a big question that beginners have about trading options is, can you trade or can you close a position before its expiration date? And since this option has 150 days left until expiration, and I have a $300 profit on it, you might be wondering, do I have to hold until June expiration or can I close it now? The answer is that you can always close an option position before expiration. So to close this position, I can just click on this option, right click, hit close position, and this brings up an order to sell this call option. And it brings up the mid price of $14.85, which is simply the mid price or the middle point between the bid and the ask price. So whenever we enter an option position, it's a good idea to start at the mid price and then see if you can get filled at that mid price. If you don't get filled, then you have to adjust the price to a slightly worse price for you. And since we're selling this option, that means that I need to decrease the price. So I'm going to try to sell this for $14.90, and to lock in that price to stop it from changing as the option price changes, I'm just going to click on this little lock here. And the platform is telling me if I sell this option for $14.90, my profit is $280. And that makes sense since I purchased it for $12.10. If I sell it for $14.90, I will make a $2.80 gain on the price. But of course, we have to multiply that by 100 to get the actual profit of $280. So I'm going to try and sell this option for $14.90. I'm going to click review and then send order. So now if we go back to the positions tab, we will see that under my Amazon position, it says I still have this 90 strike call, but I have this working order to sell this call option for $14.95 or $14.90. We have the LMT, and that means limit price. It meant that I had a limit sell order at $14.90, meaning that I would not sell this option if I couldn't sell it for $14.90 or higher. But as we can see, I just got filled on that trade, and I've successfully closed this call option position for a $280 profit since I purchased it for $1,210, and I just sold it for $1,490 after Amazon stock price went up. And I held this trade for just over a month. So I just wanted to make this example to show you what it looks like to actually purchase a call option, see its price changes over a period of time, and then close that option position for a profit or a loss. Fortunately, in this example, I made a $280 profit on this trade over a 39-day period. Now that we've covered how call option positions make or lose money in depth, let's talk about what happens to call option positions at the time of expiration. If the stock price is below the call option strike price at expiration, the outcome is very simple. The outcome is that the call option will have a value of 0, since there's no value in having a call option that can purchase shares of stock at the strike price, which is currently above the market price of the shares. We can just buy shares of stock at the market price, which is lower than the call strike price. And since there's no more time left for the stock price to increase and leave that call valuable, the call option receives a final value of 0, and it will disappear from your account if you are holding a call option and the stock price is below the strike price at the time of expiration. So if you hold it through expiration, it will disappear from your account and you will be left with the maximum loss potential for buying and holding that call option through expiration. If the stock price is above the call option strike price at the time of expiration and you hold the call option position through expiration, the call option will automatically get exercised, which means you will immediately purchase 100 shares of stock per call option contract at the call option's strike price. For example, if you have $10,000 in your account and you allow a 200 strike call to expire in the money, you'll buy 100 shares at $200 per share, and that means you will spend a total of $20,000 on those shares. And it doesn't matter how much money you have in your account. If you allow that 200 strike call to expire in the money, you are going to be left with a $20,000 stock position in your account. You'll need to close these shares immediately, or your brokerage will do it for you if you don't have the appropriate amount of money in your account to actually hold that $20,000 stock position. This is a really dangerous scenario because if the stock price gaps lower after you've purchased these shares through automatically exercising that call option, then you could have a huge loss on your plate and you could potentially get wiped out altogether in the most disastrous of scenarios. So in this scenario, it would be possible for the stock price to plummet and you take a huge loss from the share position, such as if the share position went from $200 to $100 overnight after expiration, and then you sold the shares for $100 a share. So since you bought a $20,000 stock position and it plummeted overnight and you sold that position for $10,000, you would take a $10,000 loss. And if you only had $10,000 in your account before that happened, then you would have been completely wiped out from that trade. With this being said, it's always a good idea to close option positions before expiration. It's especially dangerous if you think the call option is going to expire out of the money because the stock price is below that strike price, but then in the moments before expiration, the stock price goes above the strike price, and then you end up automatically exercising those call options and ending up with a large stock position. I would always recommend closing your option positions before expiration to avoid this unwanted scenario.